Classic technical analysis taught in most trading books is kinda outdated. Many concepts don't work in today's markets. In this video, we'll be exploring the power of price action and smart money trading, what works and doesn't work when you analyze a chart, and how you can use it to your advantage in any market. You know the drill. Like, subscribe, and stick around for the full video. After a day with lots of volatility and the price move way above its average true range, always expect a consolidation the next day. A period of consolidation after a big momentum move is a natural part of the market cycle. There are a few reasons why a period of consolidation may follow a big momentum move in trading. First is profit taking. After a big move in one direction, smart money may take profits on their positions. This selling pressure can lead to a period of consolidation as the market pauses to digest the recent move and determine the next direction. Reassessment could be another reason. A big momentum move may be driven by a news event or some other catalyst. After the initial reaction, traders may pause to reassess the situation and consider the longer-term implications of the event. This can lead to a period of consolidation as the market waits for more information or clarity. Lack of buyers or sellers is another cause. After this big momentum move, there may be fewer buyers left to push the market further in the same direction. Without new buyers, the market may struggle to maintain the momentum and obviously enters a period of consolidation. From now on, when you spot a very aggressive day with price moving firmly in one direction, you know that the market will balance out. Prepare yourself to trade that range. Every trading book tells you to trade triangles and wedges, to wait for the perfect breakout and just enter a trade. This trading method is outdated in my opinion and will lead to many losing trades. Let me explain. Triangles and wedges are patterns that are formed when the market is consolidating within a narrow range. One reason why it's generally not a good idea to blindly trust triangles or wedge breakouts is that these patterns can be prone to liquidity clearouts. Most of the time, price appears to break out of the pattern, but then quickly reverses and returns inside. This is very common in triangles and wedges because these patterns are often characterized by low volatility and a lack of clear direction. Another reason to be cautious about trusting triangles or wedge breakouts is that they can be used by smart money professional traders to trap retail traders. Smart money may intentionally create a false breakout to lure retail traders, who may then enter positions based on the breakout, only to see the price quickly reverse. Smart money can then profit by taking the opposite position as the retail traders, who are now trapped in a losing trade. So maybe you should avoid trading these patterns, especially if you're in your first years of trading. Making a fresh higher high or a lower low on a chart doesn't necessarily mean the existing trend will continue right away. In an uptrend, for example, demand areas are being respected and supply areas are being taken out. Why is that? Well, during an uptrend, the overall sentiment in the market is bullish, meaning there are more buyers than sellers. As a result, demand is greater than the supply, causing the price to rise. During uptrends, demand areas will support the price and prevent it from falling further. As a result, demand areas are often respected, and the price may bounce off these levels or consolidate before continuing the uptrend, while supply areas are taken out. In an uptrend, the bullish sentiment may be strong enough to overcome the supply and push the price higher, breaking through the supply area. A higher high should remove previous supply to validate the demand zone. The same is true for a downtrend. Here, supply areas are being respected and demand areas are being taken out. A lower low should remove previous demand to validate the previous supply zones. Candlesticks that consist of a long tail or wick and a small body are one of the best formations to trade. The long tail indicates a rejection of a certain price level, and the candle is often used as a reversal signal. But it's generally not a good idea to trade pin bars that formed after large movements, because these patterns may not be as reliable in these circumstances. These pin bars can be influenced by the volatility and momentum of the preceding move. For example, if a pin bar forms after a large downward move, it may indicate a rejection of the lower price and a potential reversal to the upside. However, if the downtrend move was caused by a strong bearish catalyst, the reversal signal may not be reliable, and the price may continue to fall. Another reason is because pin bars may form when big players are taking profits off their trades. If you look at the bearish pin bar in this example, you can see it forms right after a sharp move higher has taken place. With buy trades now at a large profit, the big players obviously want to secure some of these profits. The only way they can take profits off their buy trades is if they have buy orders entering the market. This means they have to take their profits when the market is moving higher. When they take their profits, the sell orders which come into the market as a result are much bigger than the buy orders, which causes the market to fall and creates the bearish pin bar you can see on the chart. Typical price action traders will see the pin bar and will think it's a good idea to take a short trade, when the reality is that although the pin bar may cause a slight reversal to occur, it won't be long before the market continues its up move and breaks through the high of the pin. So maybe it's not a great idea to trade the pin bars which form after large movements have taken place. Buying and selling climaxes are important market conditions to watch for, because they can provide insight into the strength of the trend and the likelihood of a reversal. A buying climax, also known as a demand climax, is a market condition where there is a surge in buying activity that drives the price up sharply. This can be indicated by a relatively narrow candlestick on a price chart, followed by high volume. Here's what you have to see on your charts. Price should be in an uptrend. The last up bar should be on extremely high or ultra high volume. This tells you that the uptrend was fueled by many buyers, and the smart money had to put a lot of selling pressure to overcome this strong buying power. Ideally, the last uptrend bar should be narrow at new highs, yet it could be a long bar with close below the middle of the bar, meaning it could have a long upper shadow. The main point of this chart pattern is that you have to see a broken bullish pressure at the top of an up move on ultra high volume. After such strong volume surge, you should expect a reversal. A selling climax, also known as a supply climax, is the opposite of a buying one and occurs when there is a surge in selling activity that drives the price down sharply. Price should be in a downtrend. The last lowest bar should be on extremely high volume, suggesting the smart money entered the game, and they are trying to take over sellers. The last lowest bar should be a narrow bar, or it can be a long bar with close above the middle of the bar, meaning it could have a long lower shadow. Reversals in the market usually begin with a sharp counter-trend movement, because this movement can indicate a shift in the balance of power between buyers and sellers. During an uptrend, buyers are in control, and the price is being driven higher by demand. When the uptrend starts to weaken, sellers may begin to enter the market, and this initial selling pressure can cause the price to reverse and move downward. This is the first phase in a downtrend. Similarly, during a downtrend, sellers are in control, and the price is being driven lower by supply. When the downtrend starts to weaken, Buyers may begin to enter the market and take advantage of the lower prices. This buying pressure can cause the price to reverse and move upward. The sharp counter-trend movement that occurs at the beginning of a reversal is often driven by a sudden shift in sentiment or a news event that causes traders to reevaluate their positions. When you see that a sharp movement has taken place, you should mark the point when the move originated from as a supply or demand zone, because if it has actually been created by the smart money placing trades to make the market reverse, they'll try to get any of their additional trades placed into the market around the same point, which is the point where the sharp move originated from. And if you see the market move into the supply or demand zone created by the sharp movement, and then you spot a common price action signal, then it's usually a good sign that the market is going to reverse and create another swing in the reversal structure. Many traders are using doji formations to take trades, and this is a big mistake. I've done it myself many times, and the success rate of this approach is quite low. Doji formations are patterns that consist of a very small body with both upper and lower shadows. The pattern indicates indecision in the market, as the open and close prices are virtually the same. You are told to see it as a potential reversal signal, but there are a few reasons why it may not be a good idea to blindly trade doji formations. As the name suggests, doji formations indicate indecision in the market. This can make it difficult to determine the next direction of the trend. I mean, the open and close price are very close or the same. Why would you want to trade during these conditions? Dojis are the candlestick formations with the most false signals, particularly in times of low volatility or range-bound markets. In these circumstances, the price may bounce around within a narrow range, creating a series of doji formations that may not provide good signals. This lack of confirmation may indicate the doji pattern is not that reliable, and you should avoid trading it. An engulfing gap is a pattern that occurs when the price opens at a level significantly higher or lower than the previous candle close, creating a gap on the chart. A bullish engulfing gap is formed when the price opens lower than the previous close, and then closes above the previous open. This pattern indicates that buyers have taken control and are pushing the price higher. A bearish engulfing gap is formed when the price opens higher than the previous close, and then closes below the previous open. This pattern indicates that sellers have taken control of the market and are pushing the price lower. If you're trading stocks, this is one of the best formations to trade. After identifying and determining the type of the gap, assess its strength and the potential impact on the market. Consider factors such as the size of the gap, the volume of trading, and any other underlying news or events that may have caused the gap. Trade them in line with the dominant trend. Look for other confirmation signals that the trend is likely to continue, and you have a powerful strategy to capture the next wave in a trend. Now, if you are ready to dive deeper into the world of smart money trading, be sure to check out this video for more advanced tips and strategies. And check out our Academy program if you want to further level up your trading. Until next time.